Financial reporting. Chapter 1, chapter 1 to 8 we have covered so far. And we have covered chapter 12 that was on leases. So let's start another difficult chapter. Chapter. There are two difficult chapters. One we have covered in previous class, leases. Another difficult chapter, chapter 9, financial asset and financial liabilities mean financial instruments. Financial instruments. Before moving to this chapter, let's discuss a few things. There are two sources of finance. Sources of finance mean from where company get finance. So company get finance from two sources. One is equity and other is debt. Equity mean company source finance by issuing shares. Debt mean loan through liability. Bank loan. That mean bank loan by issuing debentures, by issuing bonds, by issuing a loan note or loan stock. To me, company get finance by issuing shares. In company get money from shareholders. And shareholder are of two types. Ordinary shares and preference shares. Against that, company pay interest. But against equity, company pay dividend. Against debt, company pay interest. Against equity, company pay dividend. Dividend means part of profit. Ordinary shareholders are normal shareholders who has invested into the company. How they have invested into the company? By buying shares of the company at stock exchange. They will get dividend based on company profit. If company incurring profit, they will get a dividend. If company incurring losses, they will get only a smile. Sorry, this year we didn't incur any profit, so there is no dividend. Equity shareholder, ordinary shareholder, if they are investing any money into the company through their shares, that money will never be paid back to them. They cannot ask the company, okay, give us our money back. Company will never ever pay their money back. If they need their investment back, they need to sell the shares at stock exchange. They cannot ask the company, give us our money back. Take your shares and give us our money back. No. Ordinary shareholder can get back their money by selling shares on the stock exchange. They cannot ask the company. They can get money back from the company on the time of death of the company. I mean, when company become insolvent, bankrupt, at that time, by selling the company shares, investor will be paid. But first, company will pay to the debt holders, mean loan holders, and if there are any remaining asset, that can be used to pay off equity shareholder. During life of the company, ordinary shareholders cannot ask for their investment money from the company. Is it fine? What's the preference shareholder? Preference shareholders are shareholders who are having a preference over ordinary shareholders. First, me, while paying a dividend, they will get dividend first, then a company will pay dividend to ordinary shareholders. They will get a dividend first and then company will pay dividend to ordinary shareholders. Preference shareholders are of two types. Irredeemable and redeemable. Irredeemable and redeemable. Irredeemable means shareholders are investing into the company and this money company will never ever pay back to them like ordinary shareholder. This money company will never ever pay back to them. So they will be treated like ordinary shareholder. Only difference is that they will get a dividend before ordinary shareholders. And they will be recorded under equity in balance sheet. The only difference between ordinary and irredeemable preference shareholder is that irredeemable preference shareholder will get a dividend before ordinary shareholder. What is meant by redeemable preference shares? Redeemable preference shares mean they will get their invested money back after a certain time period. Mean company have issued a share to them for say 5 years or 10 years. After 5 or 10 years, they will give back the share to the company and get their money back. Redeemable mean their amount will be redeemed, mean paid back to them. And they will get a fixed percentage of dividend based on their amount of investment. Like they will get 10% of their investment as a dividend every year. If they are getting a fixed percentage of dividend, their money is also redeemable. So they will be recorded under debt in financial statements rather than equity. And the dividend company paying to them will be recorded as profit and loss account. So their dividend will be recorded from profit and loss account as expense. For ordinary shareholder and irredeemable shareholder, their dividend will be paid from statement of changes in equity. For ordinary shareholders and irredeemable preference shareholders, they will be recorded under equity and their dividend will be paid not from profit and loss account, from statement of changes in equity. From retained earning, their dividend will be paid. While for redeemable preference shareholder, they will be treated like a debt and their dividend, that is fixed percentage, just like interest, that will be recorded where in profit and loss account as expense. Can you understand this? The difference between irredeemable preference shares and redeemable preference shares. Can we move on? Okay. There are different types of debts. Company obtain loan from the bank for say 10 years and there is interest on the loan. Company will pay interest every year and the loan amount company will pay after 10 years. The mean the loan amount will be redeemed after 10 years. That is debt. Other type of debt is leases. Instead of taking amount as a loan, company has taken asset, the right to use asset. Might be for 5 years and after 5 years, the ownership will be transferred to the company. So company will pay interest for the lease time period as well as company will pay the principal amount as well. Debenture mean a piece of paper that company have issued to the public to get a of loan. And these are also redeemable. Redeemable mean after 5 year company will get back that paper and amount will be given to the debenture holder. And the debenture holder will receive some interest as well. What is bond? Our loan note. Bond mean like a piece of paper that company have issued to general public to get a loan. Suppose company have issued 6% bonds for $1 million. Redeemable after 5 years at a premium of 5%. Company have issued 6% bond for 1 million, mean company took a loan of $1 million. For how much period? 5 years. After 5 years, company will pay back at a premium of 5%. What does that mean? Company will pay back not 1 million. 5% premium mean additional 5%. What is 5% of 1 million? 1,050,000 mean company will pay 50,000 extra. What is this 6%? This is called coupon rate. What is this 6%? Coupon rate. Coupon rate means return, interest company will pay to the investor who is buying your bond, who is taking your bond and giving you 1 million amount. Those investor will receive 6% coupon rate mean interest as well. And after 5 years, they will receive 1,050,000 mean 5% premium as well. Suppose and market interest rate is 8%. Company is paying interest to investors 6%, while in the market interest rate is a 8%, mean if those investors invest in a bank account, they can take interest 8%. So that is market interest rate. Why investor will buy your bond if market rate is 8% and your rate is 6%? Because you are giving them these 50,000 extra as well. If you are redeeming at a par mean 1 million, they will not buy your bonds. They will not invest in your bonds. Might be you are also issuing at 3% discount. 3%, what is 3% of 1 million? That is 30,000. Mean they will pay you 30,000 less. But they taken a bond of 1 million. And after 5 years, they will redeem at 150, mean they will get a benefit of 80,000 like this, and they will receive 6% coupon rate every year as well. Then might be they will prefer your bond. Then you can offer bond below market rate. If you're not providing discount, not providing premium on redemption, they will not invest in you. Can you understand this? Bond loan note, loan stock, company issue like that. So what was the question?
Oh, question is, the shareholder, I was shareholder, which shareholder, ordinary share, premium shareholder has the authority to take decision, about the company?
Those shareholders who are having more than 50%
Oh,
holding in a company, they can influence the company decisions. Ordinary shares are voting. Ordinary shares have voting rights. They are having voting rights. Preference shareholder doesn't have voting rights yet. And one more, what's the difference between redeemable preference shares, bonds, and redeemable preference shares is a type of debt. Bond and bank loan are also debt. Yeah. I mean, these are debt. These are liabilities of the company that company need to pay back after a certain time period. But in redeemable preference shares, there is a fixed dividend only. They will be redeemed on their par value. There is no premium. There is no discount. In bond, there could be premium on redemption. There could be discount on issue price. Debenture also. Debenture, they will be redeemed at par. And there is only interest, there is no discount. In bond will be having discount, premium on redemption as well. In a bond, sometimes company provide option to the investor. Either you can redeem the amount or you can at the time of redemption take a company shares. That is called convertible bond. Investor having option. So redemption can be in two types, either the liability amount or company share. If there is option at the time of redemption, you can take the amount or you can take a company share. So that bond will be called convertible bond. Or this will be called compound debt. Convertible bond is a compound debt where investor who is giving money to the company, lender who is giving money to the company will be having option, either he can redeem a bond at amount or at company shares. How many shares, that will be decided at a start time. In either you can get 1,000 shares of the company at the time of redemption, or you can redeem with a 5% premium. Obviously, at the time of redemption, he will check if he is getting more through shares, he can choose towards share. If company share price is lower, he can get more through redemption amount with the premium. He will move towards liability amount. Mean there is a redemption option. If there is a redemption option, either you can take share or amount lended. So that is called compound debt or convertible bonds. So can you understand these things? What is preference shares, redeemable, irredeemable? What is a bond? What is a coupon rate? What is a market interest rate? What is discount? What is premium? What is a convertible bond, also called compound debt? Now we are moving towards this chapter, chapter 9, financial instruments. Could be of two types, financial asset or financial liability. financial asset or financial liability. Financial asset mean those assets that can be converted into money form are called financial asset. We can say cash is a financial asset. We can say receivable is a financial asset. We can say any investment in terms of shares is financial asset. Inventory is not a financial asset. Why? Because that cannot be easily converted into money form. That is physical thing. Non-current assets are not financial asset. Land and building, plant and machinery, they are asset, not financial asset, because they are not in money form. Cash in money form, receivable, you will receive what? Money. Investment in shares, you can receive what? Money. How? By selling shares. So anything that is in physical form, which cannot be converted into money easily, that is asset, not financial asset. A financial asset is a contract with other party, is a contract with other party in terms of money. Receivable is a contract with our customer, they will pay you money. Investment in shares is a contract with other company. You are giving them money, and by selling share, you can receive money. I'm just talking about financial asset. We're gonna discuss about financial liability.
All current assets, financial.
You can say, but a prepaid expenditure will not be called a financial asset. Prepaid expenditure will not be called financial asset. Inventory will not be called financial asset. Tangible non-current assets, plant and machinery, motor vehicle, land and building will not be financial asset. What are financial assets? That are having a contract relating to money and that can be converted into money form easily. What's the financial liability? Any contract relating to money is a financial liability. Like you have issued bonds, you have issued debentures, that will be called financial liability because you need to pay back the money. Leases is not financial liability because it is involving asset, fixed asset, physical thing. So let's read something. Financial instrument is any contract that give rise to financial asset of one entity and a financial liability are equity instrument of another entity. You have signed a contract with other company to buy their shares. So that investment in shares, that will be your financial asset, and for other company that will be equity instrument. For other company that will be equity instruments because they will record that share cap. Why this standard is required when we are having other accounting standards on assets, liabilities, etc.? Why this standard is required? Because these financial instruments mean financial asset, financial liabilities, they are a little bit complex type of instrument. And they are increasing nowadays too much. Bitcoin is a financial asset declared in Meta. If you have invested in Bitcoins, you can record it as financial asset in your balance sheet. It has been declared as legal asset in America. Though some other Islamic countries are not accepting it, but might be after few years, they will accept it. So in recent years, there has been a huge growth worldwide in variety and complexity of financial instruments. What are they? We will discuss later on. In international financial market, there are numerous concerns about the accounting practices used for financial instruments, which led to demand for accounting standards. The concern include the following. There had been significant growth in a number and complexity of financial instruments. So that's why on financial instruments, they have defined separate accounting standard. Accounting standard had not developed in line with the growth in instruments. So if there is any change in financial instruments, so that will be incorporated into the standard relating to them only. There had been a particular problem with derivatives. For example, forward, future, swap, etc. mean these are some contracts. Like I will buy this in future, I will sell this in future. So these are some type of contract. So these contracts are called derivatives, mean financial instruments. So there is a separate standard of unrealized gain or loss mean in financial instruments. If you are trading in financial instruments, the gain or loss, that is unrealized gain loss. So where it should be recorded, there is separate accounting standard, or many financial instruments were not recognized. Entities could choose when to recognize a profit on instrument in order to smooth the profit. So we will learn these things in this time. And there are three standards on financial instruments. IAS 32, that is relating to presentation of financial instruments. Mean where they should be presented under non-current assets, under current assets, under long-term liabilities, short-term liabilities, profit and loss account, other comprehensive income. So that is relating to presentation. IFRS 7, that is relating to disclosure of financial statements only. If company is dealing in financial instruments, they need to provide detailed disclosure in the financial statement where notes to the accounts. And IFRS 9, that is relating to measurement of financial instruments. IAS 32, presentation and classification. Presentation and classification. IFRS 7 only disclosure, but main for accounting treatment, there is a accounting standard IFRS 9. IAS 32 deal with the classification of financial instruments and their presentation. IFRS 9 deal with how financial statements are measured and when they should be recognized in financial statements, measurement and recognition. While IFRS 7 deal with disclosure of financial statements. What is meant by financial asset? Financial asset is any asset that is cash itself or any contractual right to receive cash like a receivable or an other financial asset from an other entity like buying shares, buying foreign currency, or a contractual right to exchange financial asset or liabilities with an other entity under conditions that are potentially favorable. Mean you will exchange your financial asset with other entity, you will receive something like in terms of equity or any other financial assets. So the contractual right to exchange financial asset or liability, contractual right to receive cash or simply cash, these are called financial assets, or an equity instrument of an other entity. Mean buying shares in other company, obviously you will record this as investment in your financial statement. So that is also financial asset. What are financial assets? Cash, contractual right to receive cash, contractual right to exchange asset or liability with other, and equity instrument of another entity. If you have bought preference shares, ordinary shares, these will be called financial asset.
Bank is not required cash, right?
Cash at bank will be financial asset. Examples of financial asset include trade receivables, options, investment in equity shares. What is option? Option is a contract relating to future. I will buy your shares after 3 months. I will buy your shares after 3 months at this price. Say, I will buy your shares after 3 months at a price of 5.5. Suppose current market price is a 5 and you have signed a contract with the company. I will buy your shares after 3 months at 5.5. Why after 3 months? Because I don't have money now. But in option, you are having the option either to execute this or you can cancel this. After 3 months, you will see if suppose company share price have gone up 5.5, at what the rate you can buy 5.5, you will be having a gain. So you will buy. If suppose market price of share is 5.2, and you can buy from market in 5.2. If you buy according to this contract, you are paying 30 more. So you can cancel this, means you can reject this. And this is a contract in which you are having option either to execute or not to execute. As this is a contract or what? Right to receive cash or any other financial asset. And you are having option either to buy or either to reject. So this is also a type of financial asset. Meeting this first.
So suppose I make the contract, like I'll pay out 3 months. If I don't pay out the 3 months, then
If you don't pay, no issue with that, because option, you are having option either to execute or do not execute. But at the time of contract, might be they will charge you some premium, some amount. If you don't exercise, obviously they will take that amount. And this is also a type of financial instrument. What is financial liability? Financial liability is any liability that is contractual obligation, mean to pay something. To deliver cash or another financial asset to another entity. You have issued a bond, you have issued redeemable preference shares. To exchange financial asset or liability with another entity under conditions that are potentially favorable, or that will or may be settled in the entity's own equity instruments, mean convertible bonds. Either you will pay the money or you will pay company shares. Examples are trade payables, debenture loan, redeemable preference shares, bonds, either simple or convertible. Illustration 1. Identify which of the following are financial instruments. Contractual right. Inventory? No, because this is physical thing. There is no guarantee whether you can sell easily or not. Investment in ordinary shares? Yes. Payment for goods are prepayments for goods or services.
No.
No, because you will not receive cash, you will receive physical good or service. Liability for income tax. This is your statutory obligation rather than contractual obligation. This is your statutory obligation according to law rather than contractual obligation. Financial asset, financial liability is a contract with other parties, not with the government, not statutory liability. Important part. A share option. An entity's obligation to issue its own share. Share option. Either you will buy or not buy. So this is financial asset. Financial liabilities, how we will recognize. Initial recognition of financial liabilities are financial liabilities initially recognized at its fair value. This usually the net proceed of cash received less any cost of issuing the liability. Mean we obtain a loan of say 100,000, and to obtain this loan we paid some processing fee of say 5,000. At what amount we should initially recognize the liability? Net proceed of cash what you received 100,000 less any cost of issuing the liability, mean we will record liability with how much amount? 95,000. Subsequent measurement of financial liability. Financial liability will be carried at amortized cost. How to calculate this? We're gonna learn after a few moments. Other than liabilities held for trading and derivatives that are liabilities, both of which are likely to be seen with financial reporting, but how amortized cost will be calculated. Initial value plus effective interest, that is what? Market interest less interest paid. Interest paid mean coupon rate. In how liability, financial liability will be recorded on amortized cost. Initial value plus effective interest mean market rate of interest less interest paid mean what we are paying to the bondholder, that is coupon rate. How this will be calculated? Move towards this illustration 2. See here. Loan note is issued for $1,000. The loan note is redeemable at 1250. Mean 250 is the premium. We are issuing a loan note, mean bond of 1,000. We the money of 1,000, but we will pay 1250. The term of the loan is 5 years. And the interest is paid as 5.9% per annum. Effective rate of interest is 10%. Mean market rate is 10%, but your coupon rate that you will pay to the investor, that is 5.9%. How the value will be determined? Initial value that is 10,000. Effective interest rate that is 10% minus 5.9% interest paid. Coupon rate we should always calculate on the initial value. Every year how much we will pay? 1,000, 5.9% of 1,000, that will be 59. this will remain same every year. But this 10%, we need to calculate on the liability amount that is every year at the start of every year. This means there are 5 years. Initially, liability value will be 1,000. But in the balance sheet amount, we need to calculate using amortized cost. How? According to this formula, initial value plus effective interest rate minus interest paid mean 59 coupon rate. How this will be calculated? We are having a 5 years, year 1, 2, 3, 4, 5. Initial value, that is 1,000. In that, we need to add effective interest rate, that is what 10%, calculate 10% of this, and that is 100. Less amount paid mean coupon rate, that was 59. So at year end, mean in first year, in the balance sheet, we will record liability with this amount as non-current liability. For the second year, this will be the initial amount. On this amount, we will calculate effective interest rate 104, that will be added. And we need to deduct what coupon rate, that will remain same 59 because that is on initial amount. So in year 2, we will record a non-current liability with 1086. And year 3, this will be the initial value. 10% effective interest rate will be calculated on this figure minus payment, that is coupon rate, that will remain same. So at year 3 balance sheet, we will record this as a non-current liability. For year 4, obviously this will be the initial amount. 10% will be calculated on this amount and coupon rate will remain the same. So this will be non-current liability for year 4. And 5th year, this will be the initial value. 10% interest rate will be calculated on this. But we need to pay 59 as well as we need to pay the amount that we have taken because redeemable after 5 years.
Yes.
How much we need to pay? 1250. So at year 5 and there will be no liabilities. This means this we need to pay within a year. So at year 4, this will be recorded as current liability because this will be settled within a year. And there will be no non-current liability for year 4. At end of year 5, there will be neither non-current nor current liability. How much finance cost we will charge in profit and loss account? This will be charged in profit and loss account as a finance cost. Total for the 5 years, this will be this, but every year we will charge this as finance cost in profit and loss account. And in balance sheet, we need to record the liability every year, this amount. Can you understand this? Initial accounting entry, we will record cash or bank debit. Financial liability credit. Cash or bank debit, financial liability credit. So show how the value of the loan note change over its life. So it will change over its life like this. In every year, this will be the liability. At year 1 and this will be the liability, year 2, year 3, year 4. Yes.
Can you explain what exactly is the finance cost or effective interest?
Effective interest rate mean market interest rate.
So why does it affect our loan book? Because our interest is 5.9.
We are paying to the investor every year what this amount. But if we need to calculate liability using amortization basis, so we need to incorporate market rate as well. In how much expense we should charge. We will not charge whatever we are paying because we are paying this as well as we are paying this 250 extra as well. And if you see 59 into 5 plus 250, that will be equal to 45.
Sorry?
59 into 5
Yes.
plus 250.
Okay.
And this they have shown here. The debt would initially be recognized at 1,000. The total finance cost of the debt is the difference between the payment required by the debt, which is 59 into 5 plus 1250 mean 1545. And the amount we taken as the proceed of the loan, that is 1,000. So this is the finance cost that we have charged in profit and loss account. But we need to calculate liability using amortization. How we can calculate liability using amortization basis using this formula, initial value plus effective interest rate minus interest paid mean coupon rate, mean what we are paying to the investor.
Okay.
We are not paying to the investor as per 10%, we are paying to the investor as per 5.9%. Then why he is investing in our bond? Because we are redeeming premium of 250.
Okay. And will there be any questions where the interest changing?
If you compare this 545 against 1,000, 545 against 1,000. What's that person?
5.45.
545 against 1,000.
54.5.
54.5%. Investor will receive 1545. How much he has invested? 1,000 over the 5 years. And he is receiving 54.5% more in 5. So can you understand this example, how to calculate liability using amortized cost? We need to make 4 column. First column for the beginning balance, initial balance, add effective interest rate minus interest paid is equal to what? Amortized cost of liability. And this table will be used in this complete chart. In how financial liability will be calculated, initial value plus effective interest rate less interest paid mean coupon rate is equal to liability value at amortized cost. Shall we move forward? Good luck everybody with test your understanding 1, requirement 1. Year 1 to 4, you need to calculate what will be recorded in profit and loss account as finance charge and what will be recorded in a statement of financial position as liability. A company issue 5% loan note. 5% is the coupon rate at their nominal value of to 20,000. So coupon rate will remain same. What is 5% of 20,000? 1,000. That is will remain same with an effective rate of 5%. So this is market rate and amount of this will be changing according to initial value. The loan notes are payable after 4 years. What amount will be recorded as a financial liability when the loan notes are issued? Mean at start, what amount will be recorded? So we'll record debit, bank or cash with 20,000 and credit financial liability with 30,000. Now they want to know what amount will be shown in statement of profit or loss for year 1 to 4 and under statement of financial position. That we need to calculate. How? Years 1, 2, 3, 4. Initial value that is 20,000 plus effective interest rate that is 5%, 1,000 less paid that is also 1,000 is equal to what? Is equal to what? Financial liability that is 20,000 per year 1 as a non-current liability. Year 2 start, it will remain same 20,000. 10% will remain same. This will be remain same. So that will be 20,000, 20,000 again, 1,000, 1,000, that will be 20,000. And year 4, there will be 20,000, 1,000 minus 1,000 as well as how much you will redeem. There is no information other redemption at what. So that will be 21,000. So there will be nil balance. What interest rate you will charge? Year 1 to 4 in statement of financial position, statement of profit and loss first. Statement of profit and loss. Year 1, year 2, year 3, year 4, you will show what finance cost of 1,000, 1,000, 1,000, 1,000 and statement of financial position under non-current liabilities. You will show what?
Year first.
Year 1, 20,000. 20,000. And under current liabilities, you will show 20,000 here. There will be nothing here. There will be nothing here. Is that
Yes.
number 2, please? Now try number 2, please. Try number 2. What amount will be recorded as financial liability when the loan notes are issued? Bank 40,000, financial liability 40,000. What will be charged in profit and loss account from year 1 to 3 and under balance sheet from year 1 to 3? That we need to calculate. How many years? Year 1, year 2, year 3. Initially, we are having 40,000. Interest rate is what? 9%. What is 9% of this? That is 3,600 less 0. So that will be what? 43,600. Year 2, 43,600 plus 9% of this 43,600.
3924.
3924 less 0. So that will be 47,524. So 47,524 plus 9%.
7.
4277 less 0. So that will be. Now year 3 we need to redeem. Year 3 we need to redeem with a 0 plus 40,000 plus 11,800. So that will be 51,800. So that will be it. So these will be recorded as finance cost in P&L year 1 to 3. This will be recorded as a non-current liability in year 1. This will be recorded as current liability in year 2. And there will be no liability for year 3. Simple. Is that? Shall you move forward? So putting some more masala in this type of question. Number 3. Issues 4% loan notes with a nominal value of 220,000. Loan amount is 20,000. The loan notes are issued at a discount of 2.5%. Investor will pay you 40,000 less 2.5%. And 534 of issue cost are incurred. And we know financial liability should be recorded at fair value less issue cost. This means nominal value is 20,000. Discount of 2.5%. What is 2.5%? Sorry? 500 that we need to deduct. And 534 that is issue cost we need to deduct. What is the value remaining? 18966. By this amount we will record the accounting entry debit bank 18966 and credit financial liability 18966, and this is the initial value. This is the initial value. The loan note will be repayable at a premium of 10%. Mean we will redeem with 22,000. After 5 years, the effective rate of interest is 7%. What is coupon rate? That is a 4%. Effective rate will be calculated using initial value. But this will always be calculated on nominal value. What is nominal value? 20,000. So what is coupon rate? 800. So year 1, 2, 3, 4, 5. Initial value will be here 18966 plus effective rate of interest, that is 7%. What is that? What is 7% of 18966?
1328.
Sorry?
1328.
1328 and minus what? 800 is equal to closing value of what?
And like 494.
This means every year we will pay this 800 same, but here we will pay 800 plus 22,000, and accordingly we will calculate closing value that will be transferred here. We will calculate interest, but what he's asking, what amount will be recorded as financial liability when the loan notes are issued? What amount will be shown in the statement of profit or loss and the statement of financial position for year 1 only? So in P&L we will show this,
And now
and this will be recorded as non-current liability at year 1 only. Can you understand this? Shall we move forward? Okay. We have left one page here that we need to read. Deep discount bond. What is this deep discount bond? It is a type of bond that company issue below market rate. Mean coupon rate is below than market interest rate, but company issue on discount. At redemption, company can pay either the face value or company can pay premium as well. Deep discount bond. One common form of financial instrument is deep discount bond. Or deep discount bond has the following feature: issued at a significant discount to its nominal value. Meaning the bond value is 1,000, but you are issuing might be at 950. The investor will pay you 950, but will receive at redemption 1,000, or might be there is premium as well. typically has a coupon rate of interest much lower than the market rate. Full cost of borrowing is likely to include issue cost, discount on issue, annual interest payment, coupon rate, and premium on redemption as well. The initial carrying amount of the bond will be the net proceed of issue, mean what you are receiving. 1,000 minus issue cost minus discount. The third example we calculated. The full finance cost will be charged over the life of the instrument so as to give a constant periodic rate of interest. The constant periodic rate of interest, sometimes called effective rate, can be calculated in the same way that an internal rate of return, mean IRR. How the effective rate of interest is calculated using IRR. IRR, NPV. One with positive discount factor, one with negative discount factor. We need to put into the formula both the NPV, both the discount factor, and then we can calculate IRR. But in this paper, examiner will not ask you to calculate IRR. That will always be given in the question. This is the effective rate of interest. So is calculated in this paper, effective rate of interest will be given, and the bond, like most financial liabilities, will be measured at amortized cost using this formula. Let's move forward. What is preference shares? Are of two types, irredeemable and redeemable. If irredeemable, preference shares contain no obligation to make any payment. Company will never ever pay back either of capital or dividend. They are classified as equity. Redeemable preference shares are have a fixed cumulative dividend, mean dividend amount percentage is fixed, and they will be classified as financial liability. They will be recorded under debt, and their dividend will be recorded in profit and loss account as finance charge. The key element is that where there is an obligation, the instrument represent a liability. Interest and dividend. The accounting treatment of interest and dividend depend upon the accounting treatment of the underlying instrument. Equity dividend declared as are reported directly in equity. Mean statement of changes in equity, mean retained earning. It will be paid from, not from profit and loss account. While dividend on instrument classified as a liability like redeemable preference shares are treated as a finance cost from where? P&L. Test your understanding too. Good luck, everybody. On rate 8%, this means interest paid will be 3,200. Effective finance cost, mean effective interest rate is 12%. How would these redeemable preference shares, redeemable mean financial liability? Financial liability should always be calculated on amortization basis. Simple. What would these redeemable preference shares appears in financial statements for the year ended? So every year in financial statements, you will record finance cost. Please give me the figure for year one finance cost, that is 4,800. For year two finance cost figure is 4,992. Is that? And the non-current liability will be recorded in year one, that is non-current liability in year one, that will be 4,392 or 4,1600.
Oh, 4,160.
4,1600. 4,1600, and for next year 20x9, that will be 20x9, that will be
3,392.
4,3392. For how many years they have issued? Is there any information? No. So we'll record under non-current liabilities. They will be redeemed at premium. What is the premium amount not given? After how many years not given? Easy. Shall we move forward? Okay. Compound instrument. Convertible. Companies having option. Either they can take the money or they can take share. How many shares they will take? That will be decided at the time of issue. At what price? That will be decided at the time of issue. In share number, share price will be decided at the time of issue, but the investor will be having option. Either he can convert into the amount, he can redeem at amount, or he can redeem into shares. He will see. If the share price in market is higher than whatever the decided, he will take share. Because he will see where he is getting more benefit. So compound instrument is a financial instrument that has characteristics of both equity and liability, such as convertible loan, convertible bond. A convertible loan has the following characteristics: repayable at the lender option. The lender is having option. In shares of issuing a company instead of cash, meaning he can take cash or shares. He's having option. Number of shares to be issued fixed at the inception of the loan, mean at issue date. How many shares? That will be decided at issue date. Lender will accept a rate of interest below the market rate for non-convertible instrument, but they are issued normally at below market rate. Mean coupon rate is lower than market rate. What's the incentive? He can get shares as well.
Oh,
Might be in future company share value goes up. So he will choose share option. The lender is allowing the company a discounted rate in return for the potential issue of equity. These convertible instruments are accounted for using split accounting, but initially we need to record them using split accounting. We need to calculate initial amount of liability using amortized cost and the total amount and the financial liability amortized cost, the difference will be recorded as equity. Liability of debt element, as the issuer has a potential obligation to deliver cash. Equity element, as the investor may choose to convert the loan into shares. How? Illustration 3. Convert company issue a convertible loan that pays interest of 2% per annum in arrears. That is coupon rate. That will remain fixed. 2%. The market rate of 8% being the interest rate for an equivalent debt without the conversion option. The loan of 5 million is repayable in full after 3 years are convertible to equity. Discount factor are as follows. Mean at initial, we will calculate present value of the amount using for the liability. Mean we are taking cash of 5 million. But for 5 million, we need to record a liability as well as equity element. The liability amount we will calculate using present value. How? By applying discount factor. And this discount factor, for discount factor, we will use what? Effective rate of interest mean market rate. That is given here 8%. And they have given us discount factor of year 1, year 2, year 3. How we will calculate the liability amount? 5 million is the amount. What is coupon rate? What is coupon rate? 2%. What is 2% of 5 million? 100,000. 100,000. So what we will do? For year 1, 2, 3, 100,000, 100,000, but will be redeemed 100 plus 5 million. This is discount factor for year 1, year 2, year 3 that will apply to these amount. We can calculate amount this. This is present value of liability amount. With this amount, we will record the liability. Total cash we are receiving this. So the difference between these two amounts will be recorded as equity. If we are issuing compound bond, convertible bond, initially we need to split the amount cash that we have taken into equity and debt instrument. Mean accounting entry will be debit bank of how much? 5 million. Credit financial liability as well as equity element. Financial liability will be calculated using present value method based on the coupon rate. Mean we have discount factor, or if there are no discount factor, we can calculate how 1 divided by 1.08 raised to power 1 for year 1, raised to power 2 for year 2, raised to power 3 for year 3. We can get these amount through calculator. In these, we need to multiply what coupon rate, that is 2% of 5 million. So that is what? 100,000. 100,000. But here 100,000 plus 5 million. So we'll calculate amount here, 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 and this will be recorded as liability, and the remaining amount will be recorded as equity. Like this, we have calculated how much? 4,228,000. So what's the remaining amount? That is 772,000. So initially they will be recorded like that. In case of compound debt or convertible bond. Simple bond, don't need to split equity and debt. So now we can read this. Yeah. Initial recognition. The liability is measured at its fair value. The fair value is the present value of the future cash flow, interest, and capital discounted using the market rate of interest for non-convertible debt instrument. In for discount factor, what rate we should use? The market rate, effective rate, not coupon rate. The equity element is equal to the loan proceed less calculated liability element in balancing figure. Subsequent measurement. The liability is measured at amortized cost, mean the year end value we will calculate using the amortized cost formula. Initial value that we have calculated here plus effective interest rate minus same every year coupon rate is equal to non-current liability. Equity is not remeasured and remain at the same value on the statement of financial position until the debt is redeemed. That will remain same. Only liability amount will be changed every year using amortization cost basis, that formula. We need to make that table. Can you understand this? For convertible bond only. Initially, we cannot record bank debit, financial liability credit. But convertible bond, we need to record both debt and equity. Let's have a question. And they have calculated like this. This will be recorded as a finance cost in P&L over the 3-year time period. This will be non-current liability. This will be non-current liability or current liability. Even we need to add this as well here. So there, this will be current liability and here will automatically become 0. The carrying amount of liability at the end of year 3 will equal to the amount to be repaid. Test your understanding 3. Good luck, everybody. What is effective interest rate? That is 9.1%. This means we need to ignore this 2%. Compound rate is 2%. 2% of 3,600 is 720. This means we will multiply this by 720. We'll multiply this by 720, and this will be multiplied by 720 plus 36,000. What are the values here?
662.4.
662.4. 0.84 into 720.
605.
605 and 0.77 into 63720.
5.4 plus
0.77 into 36720.
4906.
Sorry, again 36720 multiplied by 0.77.
906. 49,000.
you're asking for city.
0.77 into 36720. This all together 36720.
367. 28275.
28275. And by adding all these three, 2941. So 29541, and the difference between these two values,
6459.
so this will be initial financial liability and equity. Now we need to see what will be the finance cost in P&L every year and what will be the balance sheet non-current liabilities figure. So we are having 3 years, year 1, year 2, year 3, and we are having initial cost that is 29541 multiplied by 9.1%. What is 9.1%?
8785.
8785 less we are making payment of 720. So what is the closing balance? Is that 8785? 29541 multiplied by 9.1%. No, check again.
688.
2688. What's the closing balance? $31,509. So this will be the initial balance here plus 9.1%. You multiply this into 1.091.
2867.
2867 minus 720. 33656. So this will be 33656 here plus 9.1%.
3063.
3062 less 720 is equal to exact that amount that we have taken as 36,000. This means in statement of P&L, we will charge finance cost every year, year 1, 2, 3, that will be 2688, 2867, and 3062. In statement of financial position, we will record equity that will remain same every year. That will be 6459, 6459, 6459. We'll record non-current liability that will be 31509. And current liability here, how much?
She's.
33656. And we can say this 36,000 we can record here as current liability that need to be settled after here. Can you understand this? Good luck everybody with the requirement. The last, then we'll take break. Now move towards Department 2. A company issue 4% convertible bond. Coupon rate is 4% at their nominal value of 5 million. They are taking loan of 5 million. Interest is payable annually in arrears. Each 1,000 bond is convertible at any time up to maturity into 400 ordinary shares. Alternatively, the bond will be redeemed at par after 3 years. What is par value? 5 million. The market rate applicable to non-convertible bond is 6%. The present value of a $1 payable at the end of year based on a rate of 4% and 6% are as follows. We don't need this. So coupon rate is 4% of 5 million. What is 4% of 5 million? That is 200,000. 200,000 multiplied by 200,000 multiply by 502 now 5 200,000. What's the value here, here, and here? Please give me the complete value. Yeah, give me the complete value, please. $4,734,000. So initially we will record what? Debit bank with 5 million, credit financial liability with 4,734,000, credit equity with the difference amount 266,000. So this will be our accounting entry initially. Now we need to show the other figure. So we are having how many years? 3 years, year 1, year 2, year 3. Initial value is 4,734. What is 6%? Add 6% interest.
40.
2,840.
I'm sorry, you get 404.
2,84040 or 4.
40.
Less 200,000 is equal to what?
4818.
4,818.
040.
040. So 4,818,040 plus 6%, 2,8,908 less 200,000, 8, 2 less 200,000,
Zero.
4907 122. So 4907 122 plus 6%. Less 200,000 is equal to 5 million. So under statement of profit and loss account year 1, year 2, year 3, the figures for finance cost will be 284040, 289082, 294427. And statement of financial position, the equity will remain the same, that is 266,000, 266,000, 266,000. Non-current liability for year 1 will be 4818,040. For year 2, there will be non-current liability of 4907,122, while here there will be current liability of 5 million. There will be $1-2 difference, not more than this.
1,500.
1,500? No, these calculation issues, something like that. Even 1,200 is fine.
I would need 1,000 extra.
1,000 extra, then might be there is a problem of a point rounding off errors.
Is year 2 current or non-current?
The last one is current.
No, year 2.
Year 2 will be non-current,
Okay.
because if we're gonna pay after year end, along with that 500,000, so it's non-current. So take a break. After a break, we will discuss something more for this chapter. Coming into 3 minutes.
Like, I think what I don't know which one is. I think you're supposed to pay back in January 1, something like that. Because they always said when they pay, right? Like they just check on the guns. Because you live in the beginning of the year, yeah, you should set this up 12 months and then the next one is 12 months. Yeah, the other one is was. Non-credit for those. Previously, never been on that. I think it's biggest for me is one. Like, I don't know. Yeah, that's not good. Yeah. Yeah, okay. Well, what was it?
The increased,
Where's this
the exams,
Oh, it is.
yeah,
I don't know.
5.7%.
It's probably because there's more people now. Yeah. I
Yeah,
don't know. I just feel.
yeah,
Wait, how many exams you're taking? 3? How many?
This year I paid one exam.
Oh,
So because you had one year plus the exams.
I didn't still sounds.
Yeah, for consideration.
Oh, you can take a store then.
Yeah, I didn't know they I can't take the exams. I thought I could.
PT?
Yeah,
Which then you stop studying.
yeah, I switched.
Ah, this is just too much, you know. You were taking two classes as well.
So,
I think slowly.
yeah, so I can't give exam, so I have to give exams and I was second.
Just make sure you save the recording.
Yeah,
It expires.
huh? It's not.
Yeah, 90 days. It expires 90 days. So last session, maybe it expired already. You should check.
Oh, no, no. See again?
90 days. 90 to 100 days will expire. Yeah, go save it.
Yeah, yeah, thank you for for telling
Yeah,
me.
you can.
Yeah, yeah.
Yeah.
You know. So it's a better job.
So we started like the whole day.
Important.
Came to London by 2040.
Yeah.
Like, you know, follow like most people do.
So yeah.
Most people choose to do problems.
Yeah, I saw me people like doing financial like accounting in any universities, then they're still onboarding ECC, you know. So even if you get another like subject, you know. So that's why we basically enroll ECC only. Start date is 2026. Yeah. 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 Inshallah, by that time,
ACCA. Different ACCA. Oh, okay. There was a teacher here, Mr. Ali. Oh yeah, you told me once, like I thought my uncle. Yeah. Um, but he moved now somewhere else. This is the. How far you go there? I only took MA with him, so I don't really like see much of it. Like was he good? Yeah, it's not just an MA teacher to be honest. I don't know, this is MA. But like, uh, since he was good at MA, I could bring piano, so I got a good piano score. So why did I go for another paper with him? Because when he moved, he was because he started his own school. Yeah, so why did you try it with him? So when he moved, he probably messaged me. He said, I'm gonna leave now. But he wasn't giving courses yet for like one session. So I stayed here with Mr. Zira. And Mr. Zira was like okay. Yeah, it was at the same level. It's not bad, it's not because I don't know what a good teacher is. Mr. Z is a good teacher, and Mr. Ali is a good teacher, but I don't know who's better. You know, it's different subjects. It depends on your style, was like which style of people you like. Yeah. So for me, it's just like both work. Any teacher could work with me. It's just timings, transportation, things. Yeah, it's just goes. Yeah, yeah. The one in business bay, you gotta take a bus and stuff, so. But it's in the afternoon, which I prefer, so I'm looking into it. Okay, that's harder for me. Yeah, because you're. Like you doing. Yeah, yeah. But it's on the weekends, so it's really last bar. I don't want to go on Sundays. I mean, it's fine. I'm not having it happen. Plus now we're getting on a break. Like, so like semester ending. Next time starting September. This break. Oh, September. So I'm done with like yeah. So many years. Maybe like yeah. So technically it's a 4 year degree, but you can skip the first is like a foundation degree. So I skipped it. Oh, it's accounting. Yeah, accounting and finance. So accounting and finance, so it's mostly finance. We have four subjects this semester. Two are accounts based, two are finance based. Like yeah. So you're gonna do like forensic trade. Forensic? No. No. It's like is it UK or Australian? UK, Scottish. Yeah. It's not any different than like the economy. Yeah, this and may help me a lot to yeah, because it makes the same around the world. It's just a big. No, and like all the PV stuff. What's PV? Like NPV and discounting and all that. So
Oh, financial liability we have covered. Let's move towards financial assets. Initial recognition of financial assets. An entity shall recognize the financial assets on its statement of financial position when and only when the entity becomes a part of the contractual provision of the instrument. There is contract. Against contract, we can receive cash or financial asset or equity. Initially, recognition of financial assets are measured at fair value. This is likely to be the purchase consideration paid to acquire the financial asset. Transaction costs are included unless the asset is fair value through P&L. There are two types of financial assets. Fair value through P&L FVPL, and fair value through other comprehensive income, FVOCI. Financial assets are of two types. Financial asset held at fair value through P&L, mean in simple word, fair value through P&L mean FOPL, FVPL, fair value through P&L, or fair value through other comprehensive income. So equity instruments purchase of shares in other entities are measured at either fair value through P&L or fair value through other comprehensive income. If you are investing in other companies' equity shares, so in your book, you will record at financial asset, either investment. And that will be of two types, fair value through P&L and fair value through other comprehensive income. Initially, they will be recorded at fair value. If there is any transaction cost, that will also be part of the asset. Subsequent measurement mean at every year you need to check the fair value. If suppose previous year you recorded at fair value with 100,000. Now the fair value is 110,000. There is a fair value gain of how much? 10,000. Where this gain should be recorded. If you are measuring financial asset through fair value through P&L, this gain will be charged to profit and loss account. If you are measuring through other comprehensive income, then this will be charged to other comprehensive income, will be recorded in other comprehensive income rather than profit and loss account. If there is a loss relating to fair value through P&L will be recorded to profit and loss account, and relating to other comprehensive income will be recorded in other comprehensive income. How we can see whether it is of a fair value through P&L or fair value through other comprehensive income, we will see later on. So equity instruments mean you have invested in other entity equity are of two types, fair value through P&L. Any fair value gain or loss will be charged to P&L. Or if it is a type of fair value through other comprehensive income, then any fair value gain loss should be charged in other comprehensive income rather than profit and loss account. Okay. Fair value through P&L. In if financial instrument is a fair value through P&L. This is a default category for equity investment. Mean if in question there is no indication which type of a financial instrument is that, we will assume it is of a fair value through P&L. Any transaction cost associated with the purchase of these investment are expense to profit and loss account. Mean they will be recorded on only fair value even initially. If there is any transaction cost, that will be recorded as expense in profit and loss account. If financial instrument is of a fair value through P&L, initially they will be recorded on fair value, and any transaction cost will be recorded as expense in profit and loss account and are not included within the initial value of the asset. The investment are then revalued to fair value at each year end. And if there is any gain, fair value gain, that will be recorded to profit and loss account. If there is any loss, that will also be recorded in profit and loss. So there are two types of financial assets. One is fair value through P&L, FVPL, and other is fair value through other comprehensive income, mean FVOCI. Initially, they will be recorded at fair value, but every year we need to check the fair value. If there is a change in fair value and is gain or loss, whatever is the type of financial asset, gain or loss will be recorded there. If it is of a fair value through P&L, gain or loss will be charged to profit and loss account. If financial asset is a fair value through other comprehensive income, then any fair value gain loss will be charged to the comprehensive income rather than. So if it is fair value through P&L, initially it will be recorded on the fair value, mean the amount you have invested. If there is any transaction cost, that will be expense out, that will not be added to asset cost. And subsequently, every year end, if there is any gain or loss in fair value, that will be recorded in profit and loss account. Now, if we talk about the other type, fair value through other comprehensive income. Instead of classifying equity investment as a fair value through a profit and loss account, an entity may designate the investment as a fair value through other comprehensive income. This designation must be made on acquisition and can only be done if the investment is intended as a long-term investment. If the investment is of short term, it will be treated as fair value through P&L. If the investment is long term, it will be treated as fair value through other comprehensive income. One thing. Once designated, this category cannot later be changed to the type. And under financial asset held through fair value other comprehensive income, transaction cost will be part of asset cost. In fair value through P&L, transaction cost will be separately expense out. Should not be capitalized, should not be part of the financial asset. But in case of financial asset at a fair value through other comprehensive income, the transaction cost will be added to the asset cost. And investment revalued each year. And if there is any fair value gain or loss, that will be recorded where? Not in profit and loss, in other comprehensive income and taken to an investment reserve in equity. What does that mean? Taken to investment reserve in equity. We have covered revaluation. If there is any revaluation surplus, where we record in other comprehensive income, as well as we create another account balance revaluation surplus. In similar case, financial asset at a fair value through other comprehensive income, if there is any fair value gain, we will record in other comprehensive income, as well as we will create another account balance, and the name of account balance will be investment reserve. What we will name it? Investment reserve or financial asset reserve. Investment reserve or financial asset reserve. And next year, if there is an other fair value gain, that will be added to here investment reserve. Suppose at year one, there was a 10 gain. We created investment reserve. Second year, again 20 gain. We added to investment reserve. If on third year, there is a loss of a 50, we will record this investment reserve with a 20 negative amount. In case of revaluation surplus, it never ever become negative. But if it is relating to investment reserve, mean relating to financial asset, then if there is a negative amount, we will record that negative amount in equity. Under financial reserve, financial asset reserve or investment reserve. In what could be the name of this reserve? Financial asset reserve or investment reserve. Can you understand this? So there are two types of financial assets. Fair value through P&L. Initial measurement will be on fair value. If there is any transaction cost, that should be expense out, should not be part of asset cost. Subsequent measurement, every year end, we need to check the fair value. And we need to record on fair value. If there is any fair value gain, we will charge to profit and loss account as other income. If there is any fair value loss, we will charge to profit and loss account as expense. The other type of financial asset is a fair value through other comprehensive income. Initial measurement. Fair value means the amount you have invested plus any transaction cost, mean transaction cost will be capitalized. And subsequent measurement at year end, every year end, we need to check the fair value, mean market value. If there is any fair value gain, that will be charged to recorded to other comprehensive income. And we need to create investment reserve under equity. If there is a loss, that will be charged to other comprehensive income. And should be adjusted to investment reserve if there is any. This investment reserve could become negative even. This is similar to revaluation of property, plant and equipment like IAS 16. The main difference is that this investment reserve can be negative while revaluation surplus, the name is a surplus, that can never be negative. Even relating to revaluation loss, we charge to profit and loss account rather than adjust to revaluation surplus. If a fair value through other comprehensive income investment is sold, the investment reserve can be transferred into retained earning or left in it. It's better you should transfer to retained earning. Mean this investment reserve will be eliminated. How? Investment reserve debit, retained earning credit. That instrument such as bonds or redeemable preference shares are categorized in one of three ways. Fair value through P&L, fair value through other comprehensive income, and at amortized cost. In financial asset, like investment into equity, are of two types, fair value through P&L and fair value through other comprehensive income. While debt instrument could be of three types, fair value through P&L, fair value through other comprehensive income, and at amortized cost. The default category is always fair value through P&L. The other two categories depend upon the instrument passing two tests. What are two tests? Business model test and contractual cash flow characteristics test. In the default category is fair value through P&L. And how we can decide whether it is at amortized cost type or fair value through other comprehensive income type. It will be based on two tests. One is called business model test. Other is called contractual cash flow test, business model test, and contractual cash flow test. What is business model test? Consider the entity purpose in holding the investment. In whether you are holding this investment for a long time period or short time period to generate short term income or to generate long term income. What is contractual cash flow test? Look at the cash that will be received as a result of holding the investment and consider what it comprises. What does that mean? Let's discuss further. Amortized cost type. For an instrument to be carried at amortized cost, the two tests must be passed. Business test, entity must intend to hold the investment to maturity, mean you will not sell before maturity. Mean you have bought bond of other company. If you want to retain those bond with you till maturity, this is business test for amortized cost type. Contractual cash flow characteristics, contractual term of the financial asset must give rise to cash flows that are solely of principal and interest. Contractual terms of the financial asset must give rise to cash flow that are solely of principal and interest, mean you will receive money, whatever you will receive money that will comprise of a coupon as well as principal amount. If you have made any investment in a debt instrument, like you have bought bonds, whether it is of a fair value through P&L, at amortized or fair value through other comprehensive income, the default category mean if it is not mentioned anything, that will be fair value through P&L. What is the type of amortized cost? It will depend upon two tests. Business model test mean you will hold the investment till maturity date and you will receive cash flow in terms of interest as well as principal. If a debt instrument is held at amortized cost, the interest income calculated using the effective interest as per liability will be taken to the statement of profit and loss. And the year-end asset value is similarly calculated using the amortized cost. How? Balance plus interest minus payment is equal to closing balance. In using amortization. And in this, you are receiving interest. That coupon rate you are receiving, that will be recorded into profit and loss account as other income. Now we talk about third type, fair value through other comprehensive income. What is a business model test? Entity must intend to hold the investment to maturity, but may sell the asset if possibly or buying another asset with a higher return arises. Mean you have made investment in any debt instrument like bought any of the bond. If your intention is you may sell before maturity if other higher value investment is available. So that is fair value through other comprehensive income type. If there is no option to sell before maturity to get other higher value, so that will be amortized. And what is the second? Contractual cash flow test. Contractual terms of the financial asset must give rise to cash flow that are solely of principal and interest. Mean this will be the same like amortized cost. So if there is no information given in the question, whether you will hold till maturity or sell before maturity, whether you will receive cash in terms of coupon as well as principal. There is no information given. We will treat at fair value through PN. We will treat at fair value through PNL. Whatever we are receiving, recorded in PN. If there is information given, we will hold this investment in bond till maturity date, and we will receive cash flow in terms of coupon rate, principal amount. There's no information about option we can sell before maturity. We will treat at amortized cost. But if there is information, we will hold till maturity, or we can sell before maturity if there is other higher benefit investment opportunity available. This will be treated as fair value through other companies' income. Can you understand this? If a debt instrument is held at fair value through other comprehensive income, asset is initially recorded at a fair value plus a transaction cost. In P&L, transaction cost will be recorded as expense, but through fair value other comprehensive income, transaction cost will be capitalized. Interest income is calculated using the effective rate of interest in the same way as the amount that would have been recognized in P&L using amortized cost. The interest income will be calculated using effective rate of interest. Asset will be revalued to fair value at the reporting date with gain or loss in other comprehensive income. This will be reclassified to profit or loss on disposal of the asset. And if you are disposing of asset, and on disposal, if there is any gain loss, that will be charged to P&L. But before disposal, during maturity, if there is any fair value gain loss, that will be recorded under other comprehensive income. So financial asset mean your investment in equity or debt. If it is in equity, that will be of two types: fair value through P&L, fair value through other comprehensive income. If it is of fair value through P&L, gain loss will be charged to P&L. If it is relating to fair value through other comprehensive income, gain loss will be charged to other comprehensive income. And in case of gain, investment reserve will be created under equity. And this can be in negative. Initially, fair value through P&L will be recorded on cost. Transaction cost will be expense out, while initial recognition of fair value through other comprehensive income will be based on cost plus transaction cost. If financial asset mean investment is in debt instrument, that could be of three types. Fair value through P&L, that is the default category if there is no information given regarding business test and other test. At amortized cost, this means you're gonna hold the investment till maturity and you're gonna receive cash flow in terms of coupon as well as principal. In that case, you need to record asset using the maturity formula. Initial balance plus interest using effective rate minus payment received using coupon rate, and closing balance you will record asset. And fair value through other comprehensive income test is that you gonna hold investment till maturity, or you can sell before maturity if there is any higher benefit option available. And you will receive cash flow in terms of coupon and principal. And for fair value through other comprehensive income, any gain loss, fair value gain loss will be charged to other comprehensive income. Test your understanding 4. Good luck ahead. type is that? A company invest 5,000 in 10% loan note. In that instrument you are investing, not equity. And that instrument are of three types. By default P&L, otherwise amortized, or other company's income. The loan note are repayable at a premium after 3 years. Investing for 3 years. The effective rate of interest is 12%. The company intend to collect the contractual cash flow, which consists solely of repayment of interest and capital, and have therefore chosen to record the financial asset at amortized cost. In this question, they have stated. No need to check test. What amount will be shown in the statement of profit or loss? Interest received and statement of financial position for the financial asset for year 1, 2, 3. So the same method of amortization, year 1, year 2, year 3. What is your initial cost? That is 5,000 plus effective rate. What is effective rate? 12%. What is 12% of 5,000? 600 less payment received. What is payment received? 10% coupon rate. What is that? 500. So that will be 5,100. So year 2, 5,100 plus 12%.
612.
612. Coupon rate will remain the same. That will
5,112.
5 to
One.
1. So year 3, 5 to 1 to plus 12%.
5.4.
6 to 5. Coupon rate will remain the same. So what is that?
5337.
5337. So in P&L, year 1, 2, 3, we will record interest received, that is 600, 612, 625 in statement of financial position. We'll record what? Non-current assets and current asset. In year 1, we'll record non-current assets with 5,100. In year 2, we will record non-current assets with 5,212. And in year 3, we will record current assets of 5,337. But in year 3, it is repayable at year 3. Na? So in year 3, we will receive this as well as this as well.
At premium.
This means this will be 0.
Oh, yes.
At premium, ultimately, this will be premium.
I mean,
Obviously, after year 3, it will be nil, na? Nothing left.
okay.
At end of year 3, nothing left. This means this will not come here. This 5,212 will come under current asset. That we're gonna receive within a year. Is that? And number 2. A company invested in 10,000 shares of a listed company in a November 20x7 at a cost of 4.20 per share. At 31st December 20x7, the share have a market value of 4.90. Prepare extract from the statement of profit or loss for the year ended 31st December 2027 and statement of financial position as at that date. 31st December 2027. So is there any gain or loss? Gain, how much?
7,000.
7,000. So in statement of P&L, we will record what? Gain on investment, that is 7,000. In statement of financial position under non-current assets, we will record investment with 49,000. Simple. By default, it is of P&L.
Revaluation surplus.
Oh, yeah. Revaluation surplus, is that relating to P&L or other comprehensive income? Other comprehensive income, investment reserve. It is not a type of other comprehensive income. Investment reserve will be recorded when you are recording gain in other comprehensive income. Revaluation reserve, we record in other comprehensive income and create revaluation surplus account. If it is a type of other comprehensive income, we will record this gain in other comprehensive income and will create account with investment reserve under equity. If fair value through P&L, simply gain loss charge to P&L, finish. No need to create any reserve or something like that. Is that investment reserve will be created for fair value through other comprehensive income only. Can you solve number 3 as well, please? Investment reserve
For those reasons.
or financial instrument, investment reserve.
Okay.
Revaluation surplus relating to property, plant and equipment.
Yeah.
Also 8,000.
What type is that? OCI? A company invested in 20,000 shares of a listed company in October 2007 at a cost of 3.80 per share. 31st December 2007, the share have a market value of 3.40 into 20,000. We are having loss of 8,000. The company is not planning on selling these shares in the short term and elect to hold them at the fair value through other comprehensive income. So they have stated it is a type of other comprehensive income. This means for statement of profit and loss, there will be nothing. For other comprehensive income, there will be fair value loss that will be of 8,000. How we have calculated this? 20,000 multiplied by 0.4. And for statement of financial position, under non-current assets, we will record investment with 20,000 multiplied by 3.4 That is what?
60.
68,000. And we will record under equity. Investment reserve with 8,000 negative. It can be negative. Only through other comprehensive income, we need to create this investment reserve, either in case of fair value gain or in case of fair value loss both. Is that? Shall we move forward? Yes. Test your understanding 5. Good luck, everybody. On 1st January 20X5, company bought a 10,006% bond for 9,000, incurring acquisition cost of 144. Transaction cost. If it is of fair value through P&L, this should not be capitalized. For other, should be capitalized. Interest is received annually in arrears and the bond will be deemed at a premium of 500 over its nominal value on 31st December 2007. The effective rate of interest is 11%. The fair value of the bond was as follows: 31st December 20X5, 11,000. 31st December 20X6, 10,400. Show how the bond will be accounted for over the 3-year period. If plan to hold the bond until the redemption date. This means this is of amortized cost. Bland may sell the bond if the possibility of investment with a higher return is arises. You need to make two separate calculation. You need to solve this question 2 times. So party first, using amortization. How many years? 3 years. Is there mention anywhere?
Yeah.
Yes. For
So year 1, year 2, year 3. What is the initial cost? Bland bought a 10,000 6% bond. This is the bond rate for 9,000.
this.
So your cost is 9,000.
Yes.
The bond rate you will always receive on the face value of the bond, that is 600. You will receive 600. So 9,000 plus 144. So 9144 is your initial. Plus effective rate of interest is 11%. How much is 11% of 9144? 1006 less 600. 954
0.
9550.
Yes.
Year 2 9550 plus 11%.
1050.
Lakh 600. Year 3 10,000 plus 6%
1100.
is 8 minus 600. So in statement of profit and loss,
Like 500 over it.
obviously we will receive this 10,500 next. We will receive not the face value. We will receive 10,500.
400.
10,400. 10,000 plus 1,100 minus 600. 1,100 minus 600 is equal to 500. 1,100. 11% is the effective rate of interest. So statement of profit and loss account year 1, 2, 3, what you will record interest, income or interest received, that is 1006, 1050 and 1,100. And under statement of financial position, under non-current assets and under current asset, your investment year 1, that will be 9550 and in year 2 that will be 10,000. In year 3 there will be nothing because you will receive back. So now part B. Fair value through other comprehensive income. $9,144 is the value of bond and you are receiving 6% coupon rate. Initial value is 9,144 as well. 9,144 as well. Is that? for year 1 to 3. Is that or not?
I want that.
So we need to record what could be for statement of profit and loss figure and what could be statement of financial position figure. And they are stating at 31st December 20x5, the value is this. At 31st December 20x6, the value is this. This means we need to compare these values. If the value is this in your book, while the market value is what? 11,000. So fair value is 11,000 here and 10,400 here. So is there any gain or loss? In first, we are having gain 1450, and in second we are having gain of 400. These should be recorded where? Other comprehensive income. And under statement of financial position, we will record non-current assets with the value 11,000 at year 1 and 10,400 at year 2. And under equity, we need to record anything. Yes. What? Investment reserve. At year 1, we will record what? 1450. And year 2, 400 more will be added. That will be 1850. At year 3, is there any fair value given at year 3? No. So what we will record in year 3? 10,000 plus 500, 10,500 you will receive at end of year 3. This means this 1850 will remain same.
Yeah.
Either we can convert this into retained earning. Is that? Because fair value through P&L or fair value through other comprehensive income, we need to record every year end on fair value, rather than using this amortized cost basis. But how we will calculate the fair value gain loss, that will be based on these values.
You look at like what 1450,
1450.
top right.
This one?
Yeah.
This is a value according to interest adjustment. But what is the fair value at that time in market? That is 11,000. What is fair value gain? That is 1450.
Okay,
What is gain? 1450. One thing more. Should we use this 11,000 here or 9,550? Was this 11,000 here or 9,550 here?
Again, right?
We'll make these calculation as it is.
For amortization.
Because that interest effective rate, coupon rate, that will be charged as it is. Because through this, we are getting these figure that will be recorded
Cost.
in statement profit and loss account. So here we will record, but this gain loss will be recorded where? The amount we are receiving will be recorded, or this will be recorded. In other comprehensive income, move towards other comprehensive income. Asset is initially recognized at fair value plus transaction cost 9144 for initial. Interest income is calculated using the effective rate of interest. So that will be remain same for amortized as well as fair value through P&L, other companies' income. In the same way as amount that would have been recognized in profit and loss if using amortized cost. Asset will be revalued to fair value at the reporting date with the gain or loss recognized in other comprehensive income. And this will be reclassified to profit or loss on disposal of the asset. This means in P&L we need to record. In P&L we need to record the same figure that we have recorded for amortized cost. So interest income, that will be 1006, 1050 and 1100. And in other comprehensive income, we will record what? Investment reserve. How much? 1450. And what is relating to year 2? Year 2 relating to year 2 is 400. Obviously, that will be added in year 2 to become it 1850 positive. Can you understand this? Okay, derecognition mean when we need to derecognize the financial instrument from our financial statements. There is one more topic even left, so I'm leaving it now because those people have to close the campus. Even 2-3 questions left, so remaining we will cover in next lecture. The derecognition, and there is one more topic of factoring of receivable. That is a purely theory based question. So factoring and derecognition is left, and 1-2 question practice left that we will cover in next. Also, we will cover kit questions and then move forward. So these are the two difficult chapter, leases and this financial instrument. Leases and financial instrument. Other chapter are easy. Next class.